A confidential trade document just surfaced from inside the U.S. Mint's authorized purchaser network, and what it reveals is nothing short of catastrophic. Senior investors who've spent decades building wealth in precious metals are waking up to find their exit doors have been welded shut. The wholesalers who were supposed to buy back your silver, they've gone dark. The dealers who promised liquidity, they're maxed out, bleeding cash, and some won't survive the week. This isn't a temporary glitch in the system. This is the system eating itself alive. And if you're holding paper silver right now or waiting for the right time to secure physical metal, you need to understand something. The market you thought existed died on Wednesday, January 21st, 2026. What you're seeing on your screen now is just the ghost. Robert here, and I need you to forget everything you think you know about silver prices right now. Stop refreshing the charts. Stop obsessing over whether we're heading to $96 or dropping back to $90. Because the number flashing on your screen has become fundamentally meaningless. Those digits are echoes from a trading infrastructure that ceased functioning this week. What actually determines whether you preserve your wealth or watch it evaporate isn't the price anymore. It's whether the market's basic plumbing still works. And as of this moment, that plumbing has catastrophically failed. The gears that made trading possible have seized. The unspoken agreements that allowed buyers and sellers to connect have shattered. We're not talking about a shortage here. Shortages happen in functional markets where there's simply not enough product to go around. What's happening right now is a complete system failure. It's cardiac arrest of the mechanism that supported the entire Western precious metals industry for 50 years. Internal trade sheets from one of the major authorized purchasers for the U.S. Mint just crossed my desk, and what they reveal is terrifying. Let me explain how this industry actually works, because understanding the hierarchy is crucial. At the bottom, you have retail investors, people like you and me. Above us sit the local coin shops. Above them, the online bullion dealers. But at the very top of this food chain, sitting right next to the government itself, are the authorized purchasers. These are the massive wholesalers with billion-dollar credit lines. They're the only entities legally permitted to buy directly from the U.S. Mint. They are, quite literally, the heart-pumping silver through the veins of the economy. Every morning at 8 o'clock, these wholesalers send out trade sheets to their dealer networks. Think of it as a menu, thousands of products listed with two critical numbers beside each one: the bid price they'll pay you and the ask price they'll sell to you. That sheet is proof the market is alive. It's proof liquidity exists. Today, that menu is blank. I'm looking at the actual sheet right now, and what I'm seeing should send chills down your spine. On the sell side, the column telling dealers what they can purchase for customers, the status is uniform. Wall after wall of red text. Sold out. Sold out. Sold out. Boss American Silver Eagles? Gone. Not available. Back order date unknown. Generic Buffalo rounds? Gone. 100-ounce industrial bars? Gone. They're not accepting orders for a single physical silver product. The wholesale shelves aren't just empty. They've been stripped to bare metal. But here's where it gets truly bizarre, where the situation transforms from a supply crisis into something far more sinister. If a local coin shop calls this wholesaler today with a customer holding $1 million cash desperate to buy silver, the wholesaler has to say, "I cannot help you, the metal does not exist." That's concerning, sure. Shortages mean demand is high, but what's really signaling total collapse is the buy side. Usually, when a dealer is sold out and desperate for product, they scream for inventory. They raise their bid price. They tell the market, "We'll pay you $2 over spot, $5 over spot. Just bring us the metal." That's how healthy markets respond to scarcity. High prices cure low supply. But not today. Today, we're witnessing something that shouldn't be mathematically possible. The status on the buy side, the price they'll pay you for your silver, reads, "No bid." Let that penetrate. No bid. The major wholesalers have stopped buying back metal entirely. They've turned off the buy button. If you drove an armored truck to their loading dock right now, filled with 10,000 ounces of pristine silver bars, they wouldn't open the gate. They wouldn't make you an offer. They'd turn you away and say, "We cannot buy this. We do not want it." How is this possible? How can a business be simultaneously sold out, desperate for product to sell, and refusing to buy product at the exact same time? It sounds like a paradox. It sounds insane. If you've got customers waving cash at you, why wouldn't you buy the metal to sell to them? And here's where I need you to pay very close attention, because what I'm about to reveal explains not just what's happening, but why your entire understanding of this market may have been built on false assumptions. This isn't a supply crisis anymore. This is a capital crisis. This is a liquidity death spiral. It's not that they don't want the metal, they're desperate for it. Their entire business depends on having metal. The problem is they don't have the money to pay for it. The wholesalers are maxed out. Their bank accounts are frozen. Their credit lines are tapped to the absolute limit. Their cash flow has evaporated. They're sitting in empty warehouses, paralyzed, unable to restock and unable to trade. They're solvent on paper. They might have assets worth hundreds of millions, but they're dead in the water because they have no liquidity. They literally cannot write the check to buy your silver. This is the moment where the market ceases to be a market. A market requires two things: a buyer and a seller. Right now in the United States, we have neither. We have sellers, you, who can't find a buyer, and we have buyers, customers, who can't find a seller. The middleman, the bridge connecting the two, has collapsed into the ocean. The engine is seized, the oil has run dry, and when the wholesale market freezes, the entire supply chain freezes with it. Local coin shops can't restock, so they close their doors. Online dealers can't hedge their positions, so they either widen their spreads to 50% or shut down their websites entirely. The liquidity just vanishes. You're probably asking, how did this happen? How did the biggest, most capitalized companies in the industry run out of money during the greatest silver boom in history? Shouldn't they be rich? Shouldn't they be swimming in profits? That's the cruel irony here. The very mechanism they use to protect themselves is the mechanism killing them. The tool they deployed to ensure their business against a crash is the weapon destroying them in a boom. To understand this disaster, to understand why $95 silver is a death sentence for dealers, you have to look at the hedge. You have to examine the trap they built for themselves using the COMEX. Let me peel back the curtain on the dirty secret of the bullion industry. Let me explain the margin call nightmare currently draining every dollar of liquidity out of the United States. Let me show you why the banks are calling in their loans and why success has become failure. You're probably sitting there scratching your head, looking at silver hovering near $95 and thinking, wait, if these dealers have warehouses full of silver and the price just quadrupled, shouldn't they be popping champagne corks? Shouldn't they be buying islands in the Caribbean? It's a logical question. If you own an asset and that asset goes to the moon, you get rich. That's how it works for you, the stacker. But that's not how it works for the wholesaler. Here's the dirty secret nobody talks about, the mechanism that has turned the greatest bull market in history into a funeral for the very people who built the market. A wholesale bullion dealer is not a speculator. They're not gambling on the price of silver going up or down. They're a logistics company, a moving company. Their business model is simple. Buy a bar of silver for spot plus $1, sell it to a coin shop for spot plus $2. They make money on the spread. They make money on volume. They don't care if silver is $20 or $200. They just want to move the metal. But to run a business like that, to hold $50 million of inventory in a warehouse without going bankrupt if the price drops, they have to protect themselves. They have to insure their inventory. And how do they do that? They use the COMEX. They use the futures market. Every time a major wholesaler buys 1,000 ounces of physical silver to put on their shelf, they immediately turn around and sell short 1,000 ounces of paper silver on the COMEX. Why? Because it makes them market neutral. If the price of silver drops by $10, they lose $10 on the physical bar in their vault, but they make $10 on the short position. The two cancel each other out. They're safe. It allows them to sleep at night. It allows them to get massive loans from banks because the banks see that the inventory is hedged. It works beautifully in a flat market. It works beautifully in a bear market. But in a violent, vertical, explosive bull market, it's a suicide vest. Let's do the math of the disaster happening right now. Imagine a dealer bought 1 million ounces of silver back when the price was $25. They paid $25 million for the metal, and to hedge it, they sold short on the COMEX at 25. Everything's fine. The bank is happy. But then the Venezuela raid happened. Then the China panic happened. Then the U.S. government buy program happened, and the price of silver rocketed to 95. Now look at the dealer's balance sheet. On the asset side, they look like geniuses. Their physical silver is now worth $95 million. They have a massive paper gain. But look at the liability side. They're short at 25. The market is at 95. They're losing $70 on every single ounce they hedged. That's a paper loss of $70 million. In theory, it still balances out. The asset covers the liability. They're still neutral. But there's one difference. One fatal difference that kills companies: cash flow. The physical silver in the warehouse doesn't pay you cash until you sell it. It just sits there. But the short position on the COMEX, the exchange doesn't wait. The exchange demands cash every single night. It's called a margin call. When the price goes up $1, the dealer has to wire $1 million in cash to the exchange by the next morning to keep the position open. When the price goes up $70, they have to wire $70 million. Cash. Not silver. Not promises. Cold, hard, fiat currency. Where does a dealer get $70 million in cash overnight? They don't have it in the bank. Their money is tied up in the metal, so they borrow it. They have revolving credit lines with the big bullion banks: J.P. Morgan, Bank of America, HSBC. These credit lines are designed to handle normal volatility. But this is not normal volatility. This is a hyperinflationary event. The price move has been so violent and so fast that it's burned through the credit lines. The dealers have borrowed every single penny the banks will lend them to pay the margin calls. They've maxed out the credit card. And now the bank has called and said, "No more. We will not lend you another dollar. You're too leveraged. You're too risky." This is the liquidity freeze. The dealer is sitting on a mountain of silver worth hundreds of millions of dollars. They're technically rich, but they're cash poor. They're illiquid. They can't sell the silver fast enough to raise the cash to pay the margin. And because they've maxed out their credit lines, they can't buy new silver. If you walk in with your silver to sell to them, they need cash to pay you. But all their cash is going to the COMEX. All their cash is going to satisfy the margin clerk at the exchange. They literally do not have the liquidity to write you a check for $5,000. So they put up the no-bid sign, they shut down the buying desk, they freeze operations. It's the ultimate irony. They bet on the dollar, they use the dollar system, the futures market, to protect themselves. And now the collapse of the dollar, which is driving the price of silver up, is destroying the dollar-based hedge that holds their business together. They're chained to a sinking ship. The physical market wants to fly, but the paper anchor is dragging them down to the bottom of the ocean. And don't think for a second that the banks will save them. The banks, J.P. Morgan and the rest, are the ones collecting the margin calls. They're the ones on the other side of the trade. J.P. Morgan is long. The dealers are short. J.P. Morgan is draining the dealers dry. They're taking their cash. And soon, they'll take their inventory. When a dealer defaults, when they can't make the margin call, the bank seizes the collateral. The bank sends trucks to the warehouse and takes the physical silver. This is a consolidation. This is a takeover. Now, while you're processing that information, there's something even more disturbing happening that I need to show you. Because while the United States wholesale market is in suspended animation, a zombie market where the lights are on but nobody's home, the rest of the world isn't waiting. The rest of the world doesn't hedge. The rest of the world deals in cash and carry. And there's one country that has smelled the blood in the water. The computer at these wholesalers says sold out, because if they sell the metal, they have to unwind the hedge and they don't have the cash to realize the loss. The computer says no bid because they don't have the credit to buy. It's a deadlock. And while the United States is paralyzed by this financial engineering disaster, while New York is choking on its own paper derivatives, there's one country that sees this paralysis in the West as the opportunity of the century. We need to turn our eyes to the East. We need to talk about India. Because while U.S. dealers are staring at their margin calls, Indian dealers are staring at a record price of $113, and they're turning on the vacuum cleaner. The center of gravity for the global silver market has violently shifted. It's moved 5,000 miles to the east. It's landed in Mumbai. And if you want to know what the real price of silver is, if you want to know what a free market looks like when the paper shackles are removed, you need to look at the Multi-Commodity Exchange of India, the MCX. Because right now, India isn't just participating in the market. India is conquering it. The closing data from the Indian trading session just came in, and the numbers are absolutely historic. The price of silver on the MCX has just shattered every previous record. It hit $113.88 per ounce. Let me say that again so the traders in New York can hear it. $113. And that's not a premium price for a special coin. That's the wholesale benchmark price for a kilogram bar. If you convert the local currency, the rupee, at the current exchange rate, they're paying 335,521 rupees per kilogram. That's a number that would have sounded like science fiction just 6 months ago. But today, it's reality on the ground. Now compare that to the number flashing on your American screen. Your screen says 95. India says 113. Usually, silver flows from the mines in Mexico to the vaults in London and New York. That's the traditional route. But today, that route has been hijacked. Why would a refiner in Switzerland sell a bar to a New York bank for $95 when they can put it on a plane to Mumbai and sell it for $113? They wouldn't. They're capitalists. They follow the profit. The United States is being drained. The United Kingdom is being drained. We're witnessing a massive physical flight. The metal is leaving the West, where it's treated as a paper gambling chip, and it's going to the East, where it's treated as money. The reason for this panic in India is specific and urgent. Rumors have been swirling in the bazaars of Delhi and Mumbai for the last 48 hours that the Indian government is about to slap a massive import tariff on silver to protect the rupee. The Indian people know their government. They know that when the government threatens a tax, they do it overnight. So the people are front-running the ban. They're panic buying. It's a stampede. Housewives are buying jewelry. Farmers are buying anklets. Businessmen are buying bars. It's not speculative buying. It's cultural buying. It's wealth preservation buying. And unlike Americans who buy paper ETFs, the Indians buy the real thing. They take delivery. They hold it. This $18 premium is the death knell for the COMEX. You cannot maintain a paper price of 95 when the physical market is trading 20% higher. The arbitrage is too powerful. Traders, the smart ones who still have credit lines, are buying the cheap paper contracts in New York, demanding delivery and shipping the metal to India. They're stripping the COMEX to feed the MCX. This is why the wholesale market in the U.S. is broken. U.S. dealers can't compete. They can't pay $113 because their customers in Ohio won't pay it. So the metal bypasses America completely. The U.S. has become a flyover state for the global silver trade. The metal flies over New York and lands in Mumbai, and this creates a feedback loop. As the metal leaves the West, the shortage in New York gets worse. The sold-out signs get more permanent. The no-bid liquidity crisis gets deeper because there's no metal flowing back into the system to replenish the liquidity. It's a one-way street. India buys. The West bleeds. And while the Indians are sucking the physical market dry, something extremely disturbing is happening in the paper casino that's supposed to regulate all of this. Something has changed in the behavior of the big banks on the futures exchange. For weeks they were playing games. They were rolling their positions. They were kicking the can down the road. But on Tuesday the music stopped. The game changed. We need to look at the COMEX deliveries. We need to look at the February contract. Because the data shows that the banks have stopped rolling and started taking. They know what India is doing, and they're preparing for the vault to empty. While the wholesale dealers are freezing and India is burning hot, the most telling signal of all is coming from the one place that usually lies to us. It's coming from the belly of the beast. It's coming from the COMEX futures market in New York. For the last 3 weeks, we've watched the banks play a very specific game called rolling. They were taking their positions in the spot month, January, and frantically rolling them forward to March or May. They were kicking the can down the road. They were saying, "We don't want the metal now, we'll deal with it later." They were desperate to avoid delivery. They were desperate to keep the paper game going. But on Tuesday, something changed. The music stopped. The rolling stopped. The taking began. The delivery data from Tuesday's close shows an undeniable shift in behavior. Instead of pushing contracts into the future, the banks suddenly decided to stand their ground and demand the metal now. The total deliveries for the January contract, a contract that's supposed to be a non-delivery ghost town, have now exploded to 42.65 million ounces. Let's put that number in perspective. 42 million. In a normal January, you might see 2 or 3 million. We're witnessing a 2,000% increase in physical demand during the quietest time of the year. This is not a trading anomaly. This is a bank run. The entities holding these contracts looked at the $18 spread in India. They looked at the sold-out signs at the U.S. Mint, and they said, "I'm not waiting for March, give me the bars today." And who's leading this charge? Who's the one entity that seems to know exactly when the music is going to stop? The Issues and Stops report from Tuesday tells the story. There were 243 delivery notices issued. That means 243 contracts were put up for settlement. And guess who stepped in to catch them? J.P. Morgan. Out of 243 notices, the house account of J.P. Morgan stopped, meaning they took possession of 176 contracts. That's 72% of the entire daily volume. J.P. Morgan is cleaning up the floor. They're acting like a vacuum cleaner inside the vault. Why would they do this? Why would they take massive delivery in January instead of rolling to March? Because they see the same thing we see. They see the liquidity freeze in the wholesale market. They see the Indian vacuum sucking metal out of London. They know that if they wait until March, the metal might not be there. It might be in Mumbai. It might be in a solar panel factory in Shenzhen. So they're grabbing it now. They're securing the physical asset before the system completely locks up. And the danger isn't over just because January is ending. We're now looking at the February contract. February is another non-delivery month. It's supposed to be empty. But the open interest, the number of contracts still open and active, is showing a potential demand for another 11 million ounces. 11 million. If those contract holders stand for delivery next week, and why wouldn't they with India paying 113, it will break the back of the available inventory. We're looking at back-to-back months of record drain. The pause that the banks were hoping for, the breathing room they usually get in winter, has been canceled. The drain is accelerating. This is the sign of a market that has lost faith in the future. In a healthy market, traders are happy to hold a contract for future delivery. They trust the system. In a dying market, nobody wants a promise. Everyone wants possession. The fact that rolling has stopped means that trust has evaporated. The banks are essentially saying, "I don't trust you to have this silver in March. I want it in my truck by Friday." This is the psychology of a run, and it connects perfectly to the liquidity freeze we talked about earlier. The dealers are freezing because they're short. The banks are taking delivery because they're long. Capital is moving from the weak hands, the hedged dealers, to the strong hands, the vaults of J.P. Morgan and the Indians. It's a consolidation of wealth on a scale we've never seen. But here's the tragedy. Here's the cruel twist of fate that makes this situation so desperate for the American industry. The entire U.S. precious metal sector, the dealers, the wholesalers, the logistics companies, is failing not because they were wrong about silver. They're failing because they were wrong about the dollar. They tied their fate to a dying currency. They used the dollar-based system to insure their real-world assets. And now, the dollar is dragging them down into the abyss. There's a cruel, dark irony sitting at the heart of this crisis. If you wrote this as a movie script, Hollywood would reject it for being too tragic. We're watching the total collapse of the United States precious metals industry, the dealers, the wholesalers, the logistics networks. And it's happening for the exact opposite reason you would expect. Usually when an industry fails, it's because nobody wants their product. Blockbuster failed because nobody wanted to rent DVDs. But the silver industry? They're failing because everybody wants their product. They're failing because the price of their product has skyrocketed, and the reason they're failing reveals the fundamental flaw in the entire Western financial architecture. It reveals the fatal mistake that every major dealer in America made. They tried to build a business based on sound money, gold and silver, but they built the foundation on fiat money, the dollar. Look at the philosophy of the hedge again. When a dealer shorts the COMEX to protect their inventory, what are they actually doing? Mathematically, they're betting that the dollar and silver will stay in equilibrium. They're using the paper derivative, which is a creature of the dollar system, to insure the physical metal. They effectively tied their lifeboat to the Titanic. They thought the chain would keep them steady. They thought the chain was safety. But now the Titanic is sinking. The dollar is collapsing. And because the dollar is collapsing, the price of silver is exploding to 95. And that chain, that perfect hedge, is dragging the lifeboat down with the ship. The margin call is simply the cost of betting on the dollar. Every time the dealer has to wire cash to JP Morgan to cover their short position, they're paying a penalty for trusting the fiat system. They're bleeding capital because they refuse to just hold the metal naked. They were too scared of volatility. They were too scared of the price dropping. So they insured themselves against a drop. But they never insured themselves against a melt-up. They never insured themselves against the dollar dying. And now they're the victims of their own prudence. There's another layer to this disaster: capital intensity. Back when silver was $25 an ounce, a wholesaler with a $10 million credit line could move 400,000 ounces of metal at a time. They could run a massive business on a relatively small amount of credit. But today, with silver at 95, that same $10 million credit line only buys 100,000 ounces. Their purchasing power has collapsed by 75%. The price of the metal has gone up, but the bank's willingness to lend has not. The banks aren't giving them 4 times the credit just because silver is 4 times the price. In fact, the banks are giving them less credit because they see the volatility, and so the dealers are facing unprecedented finance limitations. That's the polite corporate term for "we are broke." They literally cannot afford to run their business at these price levels. Silver has become too expensive for the middlemen to handle. It's like a gas station that can't afford to buy the gasoline to fill the tanks because oil hit $500 a barrel. The gas station goes out of business even though everyone needs gas. The silver dealer goes out of business even though everyone needs silver. This is why the buy button is turned off. This is why the no bid sign is up. They're suffocating from a lack of working capital. This creates the ultimate misalignment of interests. Right now, you, the stacker, the investor, you're cheering for silver to go to 150. You want the moon. But your dealer, the guy you buy from, is secretly praying for a crash. He's praying for silver to drop back to 50 so his margin calls stop, so his capital goes further, so he can breathe again. The industry is at war with its own customer base. The rising price is enriching the holder, but destroying the distributor. This is the end of the just-in-time model. The model that relied on cheap credit, stable prices, and infinite paper hedging is dead. It cannot survive in a hyperinflationary environment. And as these U.S. dealers fail, as they hit their credit limits and freeze operations, they leave a vacuum. They leave a hole in the market where the supply used to be. And we know who fills that vacuum. We know who steps in when the weak hands fold. India steps in, China steps in, JP Morgan steps in. The entities with the real capital, the entities that don't need to hedge because they actually want the metal, are taking over. We're watching the transfer of the silver market from the paper hands of Western dealers to the diamond hands of Eastern hoarders. So where does this leave you? It leaves you standing in front of a broken machine. It leaves you holding fiat currency in a world where the people who sell real assets can no longer accept your money. The wholesale market hasn't just paused, it has died. And we need to accept the reality of the verdict. Because if you think you can just wait for things to normalize, you're mistaken. This is the new normal. The freeze is permanent. Here's the verdict. We've looked at the trade sheets. We've seen the sold-out signs on the sell side and the no-bid signs on the buy side. We've looked at the record-breaking $113 price in India. We've looked at the internal collapse of the U.S. wholesale dealer network, which is currently suffocating under the weight of its own debt and margin calls. The diagnosis is not complicated. It's terminal. The United States physical silver market is currently in a state of cardiac arrest. The heart has stopped beating. The blood has stopped flowing. We're looking at a market that is technically open, but functionally dead. You have to understand the gravity of what no bid means. It means that liquidity, the ability to turn your asset back into cash instantly, has evaporated. It means that if you're holding silver in the United States right now, you're holding an asset that is disconnected from the local financial system. You cannot sell it to the wholesalers because they have no money, and you cannot buy it from them because they have no metal. The bridge is out. The only way to cross the river is to go where the bridge is still standing. And that bridge is in Mumbai. That bridge is in Shanghai. This brings us to the most important realization you need to make today. The price you see on your screen, the $95 trading on the COMEX, is now completely irrelevant. It's a zombie price. It's a price that exists only in a computer simulation where infinite leverage and infinite paper promises still work. But in the real world, the world where you need physical metal to build a solar panel or protect your wealth, that price is a lie. The real price is $113. The real price is whatever the Indian housewife is willing to pay to secure her family's future. And the gap between the zombie price and the real price is the cost of the collapse of Western trading infrastructure. We're witnessing the end of an era. For 50 years, New York and London dictated the price of silver to the world. They used their paper derivatives to control physical reality. Today, that control has officially broken. The West has run out of physical metal, and now it has run out of the credit needed to pretend otherwise. The scepter has been passed. The East is now the captain of the ship. India is setting the price. China is setting the floor. And the United States is just a bystander, watching its own financial plumbing explode. So what's your move? If you're holding paper silver, if you're holding an ETF or an unallocated pool account, you're standing in the middle of the liquidity freeze. You're holding a claim on a dealer that might be bankrupt by Friday. You're holding a promise from a system that has already defaulted on its own logistics. Get out. If you can still redeem for physical, do it. If you can't, realize that your paper position is a trap. And if you're holding physical silver, do not sell. Do not let a desperate dealer talk you into selling for $95 so they can survive another day. Do not throw your life raft to a drowning bank. Your silver is the only thing that is real. The wholesale market has died so that the true market can finally be born. The manipulation is over because the manipulators are broke. This is the reset. The sold-out sign is permanent. The no bid is the silence before the scream. The Western system is finished. This is Robert from What Happened After. If this information has opened your eyes to what's really happening behind the curtain, make sure you're following this channel. We're tracking every twist in this crisis as it unfolds, and what comes next could determine the financial security of an entire generation. The market is dead. Long live the price. It's over.